everyone. Welcome to today's live. So excited to have you here. And I am going to be talking about a summary of Chapter 1 of Security Analysis by Benjamin Graham and David L. Dodd. My name is May Doldelau. Hi, got Coco. Hi, CS Mersons. Welcome, Faye Zilo. My name is May. And my blog is yesfinanciallyfree.com. So I highly recommend you go there to the blog. If you haven't already, put in your first name, long LSSA. This sounds awesome. I'm glad you think so. Hi, Wild Wolf 26. Welcome. Go to yesfinanciallyfree.com. Put in your first name and email address on the right side. Get on my email list. You get a free working parent's guide to financial freedom when you do that. And you will know exactly what I'll be talking about every day when I get live. You will get replay links exclusively to your email box. Thanks for the hearts. And you will know how to get in touch with me because I actually respond to emails that I send out to my email list. I'm glad you're free now. That's awesome. So today we're going to talk about a book. Wow, this book is huge. I'm going to summarize the first chapter of this gigantic book. Why am I doing it? Well, Warren Buffett studied this book. He studied under Benjamin Graham, and he became a billionaire in his lifetime, right? So that's a good reason. And if you're into money, that's a good reason. My blog is all about money, all about becoming financially free. I used to work a bank job here in Hawaii, and now I live my ultimate dream lifestyle, part-time internet marketer, finance freedom coach, full-time mommy and wife. And I surf a lot. I went surfing yesterday. I go to the beach a lot. That's what I like to do. I went to the aquarium with my son. If you're on my email list, you saw I showed you I went to the aquarium. I made a video on our walk there. We walked by all the beaches in Waikiki. It's beautiful here. The weather is great. Hi, Trapper 1907. But back in 2009, 2010, 2011, I was bad with money, guys. I do have a great life. Hi, Hung 45. I was horrible with money, okay? And I turned my life around. How did I do that, right? That's kind of the point of all these lives I do. But basically, thanks for the hearts. I follow some simple principles. Pay yourself first, invest for passive income. Thanks for the hearts. Hi, Roni, 2000, all that. And I visualize. Yesterday, I talked about how to design your ideal lifestyle like I did. I gave you the techniques. You can check that blog at yesfinancialfree.com from yesterday. But I followed these steps. So between 2011, all those years back then, to 2016, I paid off over $40,000 of debt, improved our family's net worth by $500,000, quit my job, was making almost $500 a month in passive income. Hi, Ann Pen 1. And I started living my ideal lifestyle. Pretty cool, right? I took my son out of school. He was 3 years old when I quit. But I took him out when he turned 4 for a whole year. I took him out of preschool. And I just hung out with him. I went to the beach. I went to the aquarium. I was a full-time mother, and I loved it. Hi, 97.3. I also started coaching people, Finance Freedom Mastermind Groups. I started coaching people, thanks to the hearts, on how to turn their life around, create passive income, pay off debt, create a better lifestyle, have more time for yourself. Hi, Olgan53. So that is what I do for a living. I'm a full-time mommy and wife, part-time internet marketer, finance freedom coach, and all of it is at this blog. So today I'm summarizing chapter 1 of this book, and I have a mastermind group. We meet every Friday morning. So we met this morning and we discussed this book because this book teaches you how to choose profitable investments. And our goal is to take advantage of this down stock market and become rich. That is really our goal. We want to make a huge profit from the stock market because it is down and because the economy is tanking. We want to know how to pick the right securities, the right investments to make a lot of money. Okay? Down stock market means that the value of stocks have gone down, right? So now stocks are cheaper to buy. Hi, Jesu. Jesus, welcome. So now stocks are cheaper to buy. Yeah. It's been booming and totally disconnected from reality. It hasn't been booming. Yeah. Booming considering. Considering the current economy, it's booming, but it's actually dropped down. It's dropped in value a lot. Yeah. Hi, Alona Pape. Welcome. I love C.S. Merson. I love having people give lots of comments. He says it is extremely expensive. So this book is perfect to figure out whether it is extremely expensive. That's the whole point of reading it. And luckily, the good thing about the good thing about it is when you have an economic downturn such as this, it could last for years. So we have enough time to read this book. I am not leading people off a cliff, C.S. Merson. People are autonomous beings who make their own life choices. So we are here to study. It is an artificial yield environment. I actually don't know what you're talking about there, so I can't comment on that one, but I did repeat it for you. All right, so let's do what I said I would do. Let's summarize chapter 1 of security analysis. All right. I like learning from people who are smarter than me, so that's why I do these things. So chapter 1 of security analysis actually begins in this book, which is very big. It actually begins on page, okay, good. Low yields, which make things expensive, but when revenue and profit reporting happens, you will see a Benjamin Graham. Yes, Benjamin Graham, real downturn. Here's Benjamin Graham. Okay. So actually what I am saying here is the same as what you're saying, C.S. Merson. What is your name, by the way? I love talking to people not knowing the real name, right? Okay. Artificial and trading market. Okay, so security analysis talks a lot about what C.S. Merson is talking about. It talks about why prices are the way they are, market psychology, valuations, how to tell what's really there as opposed to not really there, things like that. Okay? All right, let's begin. Okay, so a lot of the book is people talking about the book because the book is really old, right? And so a lot of people talk about the book and talk about why the book is still relevant because the book is so old. It was written back in the 1940s or 30s or way back. So people talk about the book in the beginning to talk about why it's still relevant today and why it's still a good book to read. And then it goes to the real book. So C.S. Merson has a lot to talk about, which is very exciting. Okay, so we're going to go into the introduction. We're going to do chapter 1, and you can find out more about me on my blog. And if you have more you want to talk about, that'd be great. Hi, Stuff for Rose. I don't mind the comments. Go ahead and do the comments, but I'm going to get on task because I have 10 minutes to do what I plan to do when I go on these lives. By the way, I'm live at the same time every day, weekday. And by the way, happy pre-4th of July. Okay, let us begin. Actually, C.S. Merson is doing a lot of comments here. He's talking a lot about things that are very inside this book. And let's begin. So chapter 1 talks about the scope and limitations of security analysis and the concept of intrinsic value, which a lot of you have already talked about in these comments already. Basically, there is a way to analyze things, okay? You can analyze things. You can pick up earnings. You can figure out what the price is. You can figure out if they're paying dividends. You can look at their accounting methods. Hi, JM8221, welcome. And you can look at all of these different things, okay? So you can determine if a bond is paying a certain percentage. Is it in a company that can pay its principal back and the percentage? Or is this company, not in a position to meet its obligations, right? So there is sometimes a disconnect. So you can actually look at things. You can look at prices, look at earnings, look at how they're doing, look at their accounting practice. You can actually read that is real data you can look at and get. You can ask the company questions. If you're a shareholder, they can give you more information that you need. Okay? Now, the nice thing about this book, and C.S. Merson just asked, is there been a time in history like this? This book is written right after the Great Depression, where something horrendous happened. And they're like, is there ever going to be a time in history like this? Rates are really low in this book during the Great Depression. You know, it's just crazy, right? So it's really cool to have kind of a way to look at things from a different perspective. By the way, I love all the comments. It's very exciting. I'm just not going to address all of them right now. But you can keep commenting, and other commenters can comment back. I'm totally okay with that, okay? It's fine with me. Okay. So basically talks about how in the last 3 decades of his time, right, they've had this brilliant rise in the stock market and then this huge fall because of the Great Depression. So he's talking about a time before the Great Depression and then the Great Depression, boom, and then the slow recovery from the Great Depression. Okay, so this is what he is discussing right now. And so the market collapse in October of 1929, right, was no surprise to analysts who had their heads on their shoulders. Okay, they understood that things were, you know, too expensive. All right, and the same thing right now. Before COVID, which nobody knew would come necessarily, right? Everybody knew the market was high. Everybody knew that. I don't know if everybody knew that, but I knew that. There were a lot of analysts who knew that. People knew that complacency was high. The market was really high. You know, I was even wary of investing at all, right? So same thing. So if you were an analyst, you could see things were expensive even before the Great Depression, okay? But the experience of 1927-93 was so extraordinary a character that they scarcely provide a valid criterion for judging the usefulness of security analysis. As to the years since 1933, there is perhaps room for a difference of opinion. In the field of bonds and preferred stocks, we believe that sound principles of selection and rejection have justified themselves quite well. So in the common stock area, the partialities of the market have tended to confound the conservative viewpoint. And conversely, many issues appearing cheap under analysis have given a disappointing performance. So even if you analyze the stock and it's considered cheap, it still doesn't do well, even though analysis would say it would. Okay, so it's not always the stock analysis do well, but the bond analysis has been doing great. So they recommend that, they say that, on the other hand, the analytical approach would have given strong grounds for believing representative stock prices to be too high as early as 1937 and too low 1 year later. Okay. Welcome, guys. So many people on. Thank you. I am married. Yesterday, I took my son on a walk. You can see that on my blog. Okay, so there are 3 functions of security analysis. 1 is a descriptive function. 2 is a selective function of security analysis. And 3 is the critical function of security analysis. Wow, my live is so active today. It's very interesting. Okay. Okay, so the descriptive function of security analysis. This is the shortest section. We're going to go through this first. The function of security analysis may be described under 3 headings: descriptive, selective, and critical. The most obvious form is descriptive, where you describe basically the important facts of what you want to invest in. Okay? So standard statistics and Fitch services. A more penetrating type of description seeks to reveal the strong and weak points of the position of an issue, compare it to other issues. You know, if you want to look at AT&T, you can compare it to Verizon, you know, kind of describe what it is. They're a telecommunications company. So this is describing things. That's a descriptive function to see what you're actually looking at, yeah? Analysis of this kind is applicable to almost every issue. Appraise the factors that might influence future performance, right? Oh, Smerson's still on. C. Smerson's still on. Although I still don't know your first name. Keep calling him C. Smerson. Unless that is your name, which would apologize. Okay, so analysis of this kind is almost applicable to any issue. So you compare it, you see what it's like. Is it going to be good in the future? Or Zoom meetings, virtual conferencing, virtual stuff. Does that look like it'll be okay in the future? Okay. I love you, honey. You're cute. Okay. I'm talking to Smerson. See Smerson. Okay, the selective functions of security analysis. So you have a descriptive function. Describe it, talk about it, compare it to other things so you kind of understand it. Look at the future of the job industry. Say you're a restaurant, and you're serving Mexican food and nobody in the city sells Mexican food, that kind of thing. Okay. Number 2, selective function of security analysis. This part is where you actually look at it and decide if you want to buy, sell, or keep your stock or bond or whatever security you have. In a selective function, security analysis goes further and expresses specific judgments, all right? Determine whether a given issue should be bought, sold, retained, or exchanged for some other kind. What types of securities or situations lend themselves best to this more positive activity of the analyst, and to what handicaps, limitations is its subject? It may well, so he's going to start with some examples in here of actual security judgments he made on how to buy, sell, whatever. Hi, Bartolo. It's funny. Oh, well, I'm not going to go into it. Okay, so let's do some examples. Let's just do a few. In 1928, the public was offered a large issue of 6% non-cumulative preferred stock of St. Louis San Francisco Railroad Company, priced at $100. Okay? The record showed that in no year in the company's history had earnings been equivalent to as much as 1.5 times the fixed charges and preferred dividends combined. Lots of interesting comments. The application of well-established standards of selection to the facts in this case would have led to the rejection of the issue as insufficiently protected. So here he's just giving you a basic example. He's saying you could buy this preferred stock in this railroad company. We're talking about way back, guys, when railroads were big, okay? And you would know that it's not a good investment because they didn't make enough earnings to cover their promise, okay? A contrasting example, and this you would have figured this out by analyzing it, right? Analyzing how much they earn and figuring this out, okay? Contrasting example, in June 1932, it was possible to purchase 5% bonds of Owens, Illinois Glass Company, due 1939 at $70 a share, okay? Yielding 11% to maturity because they're 100 at par, okay? Hope you guys understand what I'm saying. $100 share, selling at $70, okay? So it was possible to purchase 5% bonds of Owens, Illinois Glass Company due in 1939. So you could buy it in 1932, it's due in 1939, buy a bond, $70 a share, okay? I'm reading your comments. I'm just not repeating them all out. The company's earnings were many times the interest requirements, not only on the average, but even at the time of severe depression. Okay, so they were making more than enough money to pay back their bond. Basically, what he's saying. The bond issue was amply covered by current assets alone, and it was followed by common and preferred stock with a very large aggregate market value. Taking their lowest quotations, here, analysis would have led to the recommendation of this issue as strongly entrenched and attractively priced. Okay? All right, guys? So, here, and he has some more examples. The field of common stocks, they have aviation securities. Wright Aeronautics Corporation stock was selling on the New York Stock Exchange at only $8, although it was paying a $1 dividend. Had for some time been earning over $2 a share and showed more than $8 per share in cash assets in the treasury. In this case, analysis would readily have established the intrinsic value of the issue and was substantially above the market price. The value was above market price. It was a good deal. Again, consider the same issue, okay? In 1928, when it advanced to $280 a share, okay? It's a big jump, guys. The dividend rate was $2. The net asset value was less than $50 per share. A study of this picture must have shown conclusively that the market price represented, for the most part, the capitalization of entirely conjectural future prospects. In other words, that the intrinsic value was far less than the market quotation. Okay? So he's giving you some examples of how analysis can show you. These are some examples of how you can use analysis to pick stocks or not pick stocks. Okay? Okay, so that's what's in the beginning here. He has examples, real examples from real life at the time. And then he starts talking about different factors, all right? Intrinsic value versus price, all right? So you can kind of figure out intrinsic value, earnings, you know, how many assets do they have? Can they cover their promise, right? All this kind of thing. But intrinsic earnings doesn't mean anything if it doesn't affect the price, all right? So the price is the main thing, right? You buy it, you sell it, you have it, you want to use the money later on. The price is important, right? So how does intrinsic value influence price, right? In the foregoing examples, it would be seen that the work of securities analysis is not without concrete results of considerable practical value, right? However, in all of these instances, he appears concerned with the intrinsic value of the security, okay? And more particularly with the discovery of discrepancies between intrinsic value and the market price. We must recognize, however, that intrinsic value is an elusive concept, right? In general terms, it is understood to be the value which is justified by the facts. Assets, earnings, dividends, definite prospects as distinct. Let us say, for market quotations established by artificial manipulation or distorted by psychological excesses. But it is a great mistake to imagine that intrinsic value is as definite or as determinable as is the market price. Some time ago, intrinsic value in the case of a common stock was thought to be about the same as book value, right? Fairly priced. This intrinsic value was quite definite. Hi, black, black, black. But it is proved almost worthless as a practical matter because neither average earnings nor average market price evince any tendency to be governed by book value. So book value does not seem to be related to price. Okay? Intrinsic value and earning power. So this idea was superseded by this other idea. Intrinsic value of a business was determined by its earning power. How much can this company earn, right? But the phrase earning power must imply a fairly confident expectation of certain future results. All right, it's not sufficient to know what the past earnings have averaged or even what they disclose about the definite line of growth or decline. There must be plausible grounds for believing that this average or this trend is a dependable guide to the future. All right, experience has shown only too forcibly that in many instances, the concept of earning power expresses a definite figure, and the derived concept of intrinsic value as something equally definite and assertable cannot be safely accepted as a general premise of security analysis. He has some examples that basically show earnings do not govern price. Okay? So what is intrinsic value worth? If intrinsic value cannot be determined and does not affect price, then what can you use? So the role of intrinsic value in the work of the analyst. Let us try to formulate a statement of the role of intrinsic value in the work of the analyst that will reconcile the rather conflicting implications of our various examples. The essential point is that security analysis does not seek to determine exactly what is the intrinsic value of a given security. It needs only to establish either that the value is adequate to protect the bond, okay, or to justify a stock purchase, or else that the value is considerably higher or considerably lower than the market price, okay? So you don't have to be exact, is what he's saying. You just have to be able to figure out if the company can make its promise, you know, and has enough room for if a depression happened, it could still make its promise, right? And that is all you need to do to analyze. And if you can analyze to the point where you can find out if the security can deliver back the value you put in and do the promise it said, then that is the role of security analysis. You don't have to have an extremely accurate relationship between intrinsic value and price. You just have to know enough about it so you get what you paid for. Flexibility of the concept of intrinsic value. So he's saying that thus, when you look at it this way, the idea of having intrinsic value to stocks, bonds, and all of these securities has to be flexible. Our notion of intrinsic value may be more or less distinct depending on the particular case. Okay, so you have to look at depending on what you're looking at, the intrinsic value may change. The values determining intrinsic value change. You have to be flexible. More definite case of concept in specific cases. So he has some specific cases here. The interborough rapid transit example permits a more precise line of reasoning than any others. Here, a given market price for the 5% bonds results in a very definite valuation for the 7% notes. If it were certain that the collateral securing the notes would be acquired for and distributed to note holders, then the mathematical relation, $1,736 of value for the 7s against $1,000 in value for the 5s, would eventually be established at this ratio in the market. But because of quasi-political complications in the picture, this normal procedure could not be expected with certainty. As a practical matter, therefore, it is not possible to say the 7s are actually worth 74% more than the 5s, but it may be said with assurance that the 7s are worth substantially more, which is a very useful conclusion. Okay, so he's kind of giving you an idea of the logic behind how they're analyzing securities. You don't have to know the exact figure. You just have to have a big enough buffer to know one is more valuable than the other. Principal obstacles to the success of the analyst. You might have inadequate or incorrect data. Okay, you might not know about the future, like COVID-19 or when CEOs tweet about something. And there is irrational behavior in the market that, how would you know? Hi, Sinuflexion, welcome. So these three things are obstacles to successful analysis. The first, inaccurate data, is actually not so bad. You can get it corrected. You can talk to the company, and there's a lot of places now that are, the New York Stock Exchange and the SEC are requiring full disclosure. So you're more likely to get accurate information now than you were before. Uncertainties about the future, there is no way you can know that, okay? Irrational behavior of the market, that is also not something you can predict, okay? There's also a hazard. If you do your security analysis and you are correct in it and you have discovered that this bond is good or this security is a good one to invest in, there might be a really long time before the market agrees with you and the price changes, okay? So let's say you think it's a bargain and you buy it really low and the market takes forever to figure that out and it's not really a bargain anymore. Does that make sense? And then by the time, in that time, it's no longer a bargain because something else changes in the company. Some other changes, so that if you had initially done your analysis 10 years later, you're like, oh, it's not good anymore. I have to get rid of it. And you lost money, okay? And the relationship of intrinsic value to market price. Basically, all these factors about a stock or a bond or anything come into consideration, but it all funnels through the public attitude, which creates the buys and the sells and which creates the price in the end, okay? Analysis and speculation, he talks briefly about that. He says you really cannot use analysis when you're doing day trading. It doesn't really help because that's more chance. And number 3, critical functions of security analysis. He says you can use security analysis. You can create critical judgments in buying, selling, maintaining, or exchanging securities. You can avoid mistakes. You can correct abuses. So if the company is actually abusing its power, you can correct it. And you can protect yourself and others when you own bonds and stocks, okay? So that is basically a summary of Chapter 1 of Security Analysis by Benjamin and David Dodd, all right? The entire summary I've written out at yesfinanciallyfree.com. Thank you so much for being on the live. I will be live again Monday through Friday, 9:30 a.m. Hawaii time, which is 3:30 p.m. Eastern time. If you're not subscribed on the YouTube channel, click subscribe, all right? And click the link below to get to the full blog post. Aloha, thank you. And if you're on Periscope, click the link in my